Hello, everybody. Welcome. We're going to do the Wiley solution walkthrough today for Accounting Tools for Business Decision Making, 8th edition for exercises 25-4 and 25-5. The authors of this textbook are Paul Kimmel, Jerry Weingen, and Jill Mitchell. The question used in this presentation is copyright 2022 by John Wiley and Sons. All rights are reserved. This is for educational purposes only. The video may not be distributed or redistributed without the express permission of Wiley. The solution presentation is copyright 2022 by Bennett Tchaikovsky. All rights are reserved. The opinions contained within this presentation are those of Bennett Tchaikovsky, not the authors of the textbook or of Wiley. Okay, before we thank the bus driver, let's go right over here. So for these particular ones, right, if you look at what we were doing before, we had to go through and do this entire crazy calculation. However, there is something over here when we have that the payments are the same every year, we can go through and basically use something called the present value of an annuity of $1. And that's only going to be if the cash flows are going to be the same every single year. So Back Corporation is considering purchasing one of two new diagnostic machines. Either machine would make it possible for the company to bid on jobs that it currently isn't equipped to do. Estimates regarding each machine are provided here. So the original cost of machine A is $75,500. Estimated life is 8. Salvage value 0. Estimated cash inflows are 20. Outflows are 5. So for machine A, my net cash inflow is I'm going to have inflows of 20, outflows of 5. So my net cash inflow is going to be 15,000. Now, with this one over here, I'm making an initial investment of 75,500. Well, what would I go through and do? Well, I could say, well, 15, 15, 15, and so on and so on and so on. But instead, what I'm going to do is, because the amount is the same amount every year, my net cash inflow years 1 through 8 is going to be 15,000 each year, annual net cash inflow. So what I'm going to do is, because the amount is the same, this is an annuity. Again, if you don't understand present value, please, please, please go and take a look at my video, my shortened series on bonds. Coming over here, so I'm going to go to the present value of an ordinary annuity of $1. Okay, I'm going to need two things. The number of times the payment's being made, 8 periods at 9%, because this is telling me right over here, that's a 9% discount rate. So over here, when I come over to the present value of an ordinary annuity of $1 at 9%, 8 periods, this is going to be 5.53482. 8 periods, so basic 8. Sorry, I got that screwed up. Hold on. Even I make mistakes. So 5.5, so 8 periods, that 8 numbers of times that payment's being made, 8, 9% is 5.53482. I'm going to come over here. So my total, basically the total present value of the future cash inflows is going to be 15 times 5.53482, or 83,022. Okay, now my outflow is my cost, and my cost over here is going to be 75,500. So my net present value of machine A is going to be 7,522.30. Let's go ahead and do it for machine B. Okay, so for machine B, my net cash inflow, well, in this one I'm getting 40,000. My outflow is 10,000 per year, so I'm going to be making $30,000. So my net cash inflow is going to be 30,000 every year. The present value factor is going to be the same, 8 periods at 9%. If you look over here, it's an 8-year payout. And then the one big difference, though, is that my outflow here is 180,000. So my net present value of machine B is going to be a negative 13,955.40. So in looking at choosing either one of these, we would go with machine B. The reason is because it has, excuse me, we go with machine A. Excuse me, we're not the government institution. We're actually trying to be profitable here. It would be machine A because it has a higher net present value. This one does not even meet our criteria. So it would be machine A when we're going through and looking at this. I don't deal with a profitability index, so have fun looking that up. Okay, let's go over here to exercise 25-5. So we've got over here, we've got Bruno Corporation is involved in the business of injecting molding into plastics. It's considering the purchase of a new computer-aided design and manufacturing machine for $430,000. Okay, so it's going to basically increase in net annual cash inflows of 101,000 for the next 6 years. Okay, so this is basically years 1 through 6. So what we can do is similar to what we just did up above, is we can now go through and say, okay, if this is going to be the cash inflows for years 1 through 6, I can now go to the present value of an ordinary annuity of $1. I can use this table because the amount is the same every single year. So this is going to be 6 periods at 10%. So when I go to the present value of an annuity of $1, this is going to be 6 periods at 10% or 4.35526. I bring that over here. So the present value of the future cash flows, right? And remember, if this wasn't the same, I would have to do this. I'd have to go and use the present value of $1 for every single one. But because it's the same, I can use this little shortcut. Now over here, my cost of the machine, this is going to basically be 430,000. So my net present value is going to be 9,881. Now, what this is asking us to do is calculate the internal rate of return on this new machine, and should the investment be accepted. So the internal rate of return is essentially what makes the net present value go to 0. And if we were to go through and do that, just give me a moment. So for the internal rate of return, it's what makes the net present value 0. Now we know by just going through and doing the present value, it has a higher, basically, it has a higher, we know that the rate of return is going to be greater than that of 10%. So to figure out the internal rate of return, we're going to take our investment divided by the annual cash flow. So the investment is 430,000. The annual cash flow is 101,000. So when we take this over here, this is if we do a number like this. So we get 4.257426. If I come over here to the present value of an annuity of $1, what I'm going to do is, because it's a 6-year payout, I'm going to kind of go over here and look at, well, we've got 4.35526. When we look at this over here, we're looking for 4.25. So check something real quick. So 430. Okay. So we're going to go over here, period 6, because this is how many times it's being paid out. And then we're going to go look for our number. And so as we're looking for our number, it's 4.257426. And when we come over here, we look at 4.257426. So it's going to be somewhere between 10 and 11%, going closer over here to the 11% side. So the internal rate of return at what makes the net present value go to 0. So it's going to be somewhere around 11%. Okay, so and if they're required to have a 10% rate of return, you would basically go through and move forward with that project. So apologize for not doing that one the way that they wanted you to do it. But again, for the internal rate of return, take the amount of the investment, you divide it by the annual cash flow. You come over here, you go to the 6 periods because that's how many years it's being paid out, and you look for a number that's reasonably close. Okay. So in any event, I want to thank you for joining me here today. I always want to thank Wiley for allowing me to do this. It's pretty rare for a publisher to do it. So again, I want to thank Wiley for letting me do this, and I look forward to seeing you on the next video. Have a great day.